Good morning and good afternoon to everybody, and thanks for joining us. I'm Krista Hughes, and I'm pleased to welcome you to today's media conference about the Bank for International Settlements December Quarterly Review. With me today are Claudio Borio, Head of the Monetary and Economic Department, and Hyung-Song Shin, Economic Advisor and Head of Research, along with the authors of the special features. As you know, this edition of the Quarterly has a special focus on analysis of the results of the triennial survey of FX and over-the-counter derivatives markets. Before we begin, I'd like to reiterate that only comments from Mr. Borio and Mr. Shin are on the record. Any author comments are strictly off the record, so not for quoting or attribution. This media conference will be recorded, and the on-the-record sections will be published on BIS digital channels next week. And a reminder that the embargo on the quarterly review, the media release, and the on-the-record parts of this briefing lifts on Monday at 1 p.m. Basel time. Mr. Borio and Mr. Shin will give brief introductory remarks, and then we'll go to the questions. We'll take questions on the overview first, please, and then questions on the special features. So we'll now start with the introductory remarks. Claudio, over to you.
Well, thank you. Thank you, Krista, and thanks to everyone for joining us today. The first section of the quarterly review examines market developments from the 13th of September to the 25th of November. This was a tale of two phases, driven by the impact of inflation dynamics and growth prospects on market expectations of the monetary policy stance. Consider core sovereign bond markets. In the first phase, which ran until mid-October, short-term yields rose briskly on the back of inflation readings that led investors to revise upwards the expected policy rate path. Events took a different turn in the second phase, from mid-October through November. Following data releases indicating that inflation was weaker than expected and that the economy was cooling, investors tempered their views of the required monetary tightening. As a result, short-term yields plateaued and long-term yields dropped. In particular, the US yield curve inverted to a degree not seen since 1995. During the review period, US medium-term forward real rates reached their highest levels since the Great Financial Crisis, back in line with long-term norms. Equally, risky asset markets danced to the tune of the changing monetary policy outlook, with a risk-on phase following the initial risk-off one. This was true for both equity prices and credit spreads. Credit spreads ended the review period close to historical norms in the United States and above them in Europe. In parallel, during the risk-off phase, the US dollar climbed to multi-decade highs before retreating as the risk-on phase set in. Financial conditions in emerging market economies mirrored these moves. The dollar's recent depreciation helped ease signs of strain in dollar funding markets as the year-end approached. Two important developments followed their own dynamics. Commodity prices declined, particularly for natural gas in Europe and for crude oil, although futures prices pointed to lingering concerns about potential shortages of long-term energy supply. And stress in China's real estate sector persisted, weighing heavily on equities in the country and its trading partners. Even as investors' perceptions waxed and waned, the fragility of liquidity conditions in various market segments came to the fore. This fragility was starkly in evidence when turmoil engulfed UK long-term gilts in September. A box in the overview draws lessons from this episode about systemic risks stemming from pension funds and other non-bank financial intermediaries. Another box points to the heightened role of small investors and leverage funds as buyers of US agency mortgage-backed securities. This could potentially weaken the resilience of market liquidity for financial instruments often viewed as a close substitute for US Treasuries. In different ways, the two boxes drive home a policy message highlighted in previous quarterly reviews: the need to put in place an adequate regulatory framework with a clear systemic focus in order to address structural vulnerabilities in the NBFI sector. This would help relieve pressures on central banks to stabilize markets during stress, not least if such interventions need to take place when the priority is to bring inflation under control, which makes them more challenging. I'll now give the floor to Hyun, who will talk about the special features in this edition of the Quarterly.
Thank you, Claudio, and welcome everyone. As Krista mentioned in her introduction, this quarterly review is a special issue featuring analyses of the 2022 BIS Triennial Central Bank Survey of foreign exchange and over-the-counter derivatives markets. You may have seen that we published preliminary data from this survey on October 27th. The core of this data set covers trading in April this year on OTC markets for FX spot, FX derivatives, and interest rate derivatives. Moving to the special features, Wen-Chan Huang and Karanfil Todorov used the survey's data to shed light on how the transition from LIBOR to so-called nearly risk-free rates has changed the over-the-counter interest rate derivatives markets. They find that this transition, known as benchmark reform, has led to material shifts in the interest rate derivatives market in terms of the instrument mix depending on the currency. Matthias Drayman and Vladislav Shusko discussed the survey's results for FX markets. The authors find that FX trading continues to shift away from multilateral platforms, where price formation is available to all participants, towards so-called less visible venues. This diminished visibility matters as it could lead to market fragmentation that undermines beneficial network effects. A market segment that is particularly hard to monitor involves US dollar borrowing in the form of FX swaps. Claudio Borio, Bob Macaulay, and Patrick Maguire explained that these instruments give rise to off-balance sheet payment obligations, mostly in dollars, that standard debt statistics miss. The size of these obligations has been very large and growing, exceeding $80 trillion worldwide. For non-banks outside the United States and for non-US banks, the hidden dollar debt is more than twice as large as that visible on balance sheets. Julian Caballero, Alexis Morin, Philip Wooldridge, and Dora Shah report in their piece that the trading of emerging market economy currencies has an increasing proportion of transactions in which at least one party resides outside the currency issuing jurisdiction. With this growing internationalization, EME and advanced economy currencies have become more alike. Now that said, trading of EME currencies remains subdued relative to underlying real economic activity as measured by GDP. The greater internationalization of EME currencies also underscores the importance of FX settlement risk, which refers to the risk that one party to the trade makes a payment but does not receive the currency it is buying. As Mark Lauker and Thomas Nielsen show, trading of major currency pairs typically involves mechanisms that minimize settlement risk, notably so-called payment versus payment, or PVP, arrangements. For many EME currencies, however, such mechanisms are not available or are very costly. Worldwide, $2.2 trillion worth of currency trades, or around 1/3 of the total deliverable FX turnover, are at risk of failing to settle on a given day. This holds the potential to undermine financial stability.
Thanks very much both for the introductions. And now we're happy to take your questions. To ask a question, please use the raise your hand function in WebEx, and then we can unmute your line, or you can type your question into the chat as a message to all panelists. If you are dialing over the phone or have technical difficulties, you can also email your question to press@bis.org. And just a reminder that we are taking questions on the overview first, and we will come back to the features in a minute. So I can see already a couple of questions in the queue. I think Rich Miller, you were first from Bloomberg. Rich, please go ahead. Rich, we don't hear you.
Hear me?
Yes, now we do. Off you, please.
Okay, thank you very much. I wonder, Mr. Boria, if you could look back over the last year. You referenced this in your opening remarks, and see how we've had arguably the most aggressive and the most broad-based tightening of monetary policy in decades. How is the financial system and financial markets performed so far? I know you referenced the gilt blow up, and obviously we've had the crypto crack up, but I think you could make the argument that so far, at least, the markets and the financial system have taken this very aggressive monetary policy tightening in stride. Would you agree with that? And if so, what does that portend? I mean, does that give us hope that we can get out of this without too much in the way of financial accidents, etc.? Thank you very much.
Well, thank you for the question. First of all, in terms of the bigger picture, which I always like to emphasize, what we are seeing is rather unprecedented if one takes a longer term view from if you like, in the post-war period, which is a period monetary policy tightening to bring down inflation in the context of financial vulnerabilities, particularly in the form of high debt, high property prices, and the like. So this is a challenging configuration, as we analyzed already in the BIS annual economic report that came out in June. Against that background, as you said, financial markets have performed quite well on balance so far. There have been a number of episodes, including the gilt edge, the problem in the gilt market in the United Kingdom, but so far the issues have been manageable. If you look at the strength of the financial system in general, however, it is useful to make a distinction between the state of the banking sector on the one hand and the state of the non-bank financial intermediation sector, as we highlight in this quarterly review, and as we have highlighted on previous issues and on previous occasions. The banking sector is in pretty good shape as a result, in particular, of the post-global great financial crisis financial reforms, regulatory reforms. It's much better capitalized than it was at that time. It's much more liquid than it was at the time. And this is also what allowed the banks to play a useful role during the surprising COVID crisis in supporting the economy. Partly also, of course, with the big support of regulation and policy more generally. I think that the picture is somewhat different when it comes to the non-bank financial intermediation sector, which has grown in leaps and bounds since the great financial crisis. This growth was actually partly intended. The idea was to tighten the regulation in the banking sector, which tends to be more leveraged, and to have some of these risks move out of the sector. But at the same time, the sector is vulnerable. There are some structural vulnerabilities. There is hidden leverage. There are hidden maturity mismatches, more or less hidden actually. And what we have seen in the UK is just one possible example of what might happen. There were previous cases as well, like the problems with Archegos, or if you go back to March 2020, the dash for cash. Again, we have analyzed that in a number of reports over the years. We touch on that again in one of the boxes of the QR. And this is something that is definitely has to be watched very closely, because it is an important vulnerability. And what might happen in the non-bank financial sector may not stay in the non-bank financial sector. It could also affect banks in various ways. And the direct or indirect exposures of the banking system to this sector are not particularly transparent. So for all of these reasons, we emphasize the importance of improve the regulation in that sector. Because it will also relieve pressure on central banks to intervene, interventions that can have longer-term issues.
Thanks. And I think the next question is James McIntosh from the Wall Street Journal. James, please go ahead.
Just about dollar funding stress at the end of the year. As you point out, it's eased a bit as the dollar's weakened, but it's still quite extreme. Is this just a general indicator of the general stress in the markets, the lack of liquidity, and so forth, or is there actually a danger that this could tip into something very bad happening around the end of the year that will require intervention to ease the situation?
Well, first of all, I would not describe the conditions in markets as extreme. You tend to have these signs of strain during when the year-end approaches, and we're just seeing some of them again. And in fact, those signs have actually weakened as a result of the recent depreciation of the dollar. So this is something which happens all the time, but we know that the dollar, as we emphasize in the quarterly review, funding market and dollar funding markets are extremely important in the global financial system because of the role of the dollar. And this is one of the reasons why one of the special features in the QR looks at what we call missing dollar debt, which is the very large, very large dollar obligations in the FX swap market, which are harder to see or completely absent in the statistics, to the point that we have to do some detective work to find out exactly what their size is. And their size turns out to be bigger than the size of dollar debt that you see among non-US borrowers on their balance sheet. So this is clearly a potential pressure point that has to be monitored closely. Now, over the years, of course, many safeguards have been put in place. Central banks have been put in place many safeguards in order to address any possible strains more effectively.
Okay, thank you. And the next question from Li Wei Wang of Kai-Chen. Li Wei, please go ahead.
Can you hear me?
Yes, we do.
Mr. Warrior, so you mentioned the UK case. I think it somewhat highlights there is sometimes constraints or burden on monetary policy from sort of fiscal authority as well. And I think at times of stress or say crisis, there is cases where there is major remittance, basically money transferred from central bank to finance ministries. As we see this year in China. Just wondering, does central bank need a rigid institution to insulate it from unnecessary kind of credibility loss? Say this kind of central bank remittance to the finance ministry, does it need to be institutionalized to protect operation success of central bank? And the central bank, say, need capital to make it more successful in implementing its monetary policy, especially,
Well, thank you. Yes, indeed, the issue of central bank transfers, transfers to the government have come to the fore recently, particularly as a result of the large-scale asset purchases of government securities that the central banks have been doing during the post-GFC period. I mean, just to explain what this is really about, is the fact that from the perspective of the consolidated state sector, broad governance sector balance sheet, which includes the government and the central bank, what these operations are doing is effectively reducing the maturity of the state sector government debt, because they're replacing long-term debt with debt which is indexed at the short-term rate, and that's basically bank reserves. And when interest rates go up, that does mean that profits of central banks are going to be reduced, or indeed that central banks will be making losses. It is indeed important to make sure that the central banks are able to operate and implement their monetary policy effectively. Central banks can operate with negative capital, and we have a number of examples around the world of central banks that are operating in that way. But depending on the specific circumstances in individual countries and the institutional setup, it is clearly important to make sure that whatever the specific arrangements are, that there is sufficient independence. The central banks retain independence in order to be able to fulfill their mandates without undue interference.
And the next question is Bastian Benrath from Bloomberg. Please go ahead.
Hello, Bastian Benrath from Bloomberg. Hello. I would like to shift the focus really more on central banks. Can you just put on a rather high level, where do you see the main challenges for central banks next year? And also, if I may add a second question, how do we are obviously in the middle of a tightening cycle, so how long do you see this going on? And do you expect seeing U-turns of central banks who are going to cut rates next year instead of tightening? Thank you.
Okay, I'm just trying. You didn't come through very clearly, but I think the first question is, what are the challenges, I think, that central banks, the main challenges central banks will be facing next year? Well, first of all, the challenge, the key, the priority for central banks, and for quite some time now, has been to bring inflation under control. And that is the core challenge that they're facing. And we analyzed that in a lot of detail in the annual economic report, explaining for a number of reasons that it was important for central banks to act in a timely and forceful way, which is what central banks have been doing. As the process goes on, the main challenge for central banks is to try and understand how far to go and how long to go there, for how long to be there. By that I mean keeping interest rates high. And that's indeed what they're trying to do. Now, it's not entirely clear what will have to be done in order to bring inflation under control. This will depend a lot on evolving circumstances. It will depend on country-specific conditions, but that is the task. And one aspect which is complicating that task is what I was mentioning earlier, the fact that we have very high debt levels around the world, both public and private, which suggests that the economy is more sensitive to increases in interest rates, but we don't quite know how sensitive it is to increases in interest rates. And complicating this task, as we in fact discussed earlier on in the first part of this press briefing, is the aspect that there may be issues arising, as they have arisen in the context of the functioning of the financial system. And that is one of the challenges that they will need to face if it materializes.
Hey, thanks. And we'll now go to Delphine Strauss from the Financial Times. Delphine, please go ahead.
Could I just ask you to elaborate a little bit on this comment in the overview on liquidity conditions in the US being even worse than they were in March 2020? What measure is that on, and what risks does it carry? Is it improving at all?
The specific measurement of liquidity conditions it's a kind of multifaceted exercise, and it depends on whether you're looking at market depth indicators, it depends on whether you're looking at bid-ask spreads and so on. So as we say in the quarterly review, depending on which indicator you take, you may come up with a slightly different picture. I think regardless of the specifics, the general point is that the conditions, as part of the bigger picture that I was describing before, financial markets exhibit in general, some structural vulnerabilities. And these vulnerabilities are aspects that have to be taken into account when implementing policy. I don't know whether, Hyun, you want to add anything or?
Yes, Delphine, thanks for that question. I think the liquidity that we were referring to in the overview has very much to do with the market microstructure type of issues. What is the bid-ask spread? What is the quoted depth? How is the, what is a typical trading size that you can, actually execute in the market? So it's more the market microstructure type issues rather than liquidity in the broader sense. As you know, liquidity is used also to refer to financial conditions more generally. Clearly, March 2020 was right in the heat of the stress event in the early days of COVID. That clearly is not what we're experiencing right now. As Claudia mentioned, in the last 4 or 5 weeks, we've seen financial conditions actually turn quite accommodative, and we've seen credit spreads come down. We've seen the dollar weaken, and also equity markets have also turned to some extent. So it's really the kinds of discussions that you see in for example, graph 2 on page 3. And some of the other discussions that you see, later on. It's more the market microstructure.
Okay, thank you. And now we'll go to Mark Jones from Reuters. Mark, please go ahead.
Can you hear me?
Yes, we do.
Great. So a couple of questions. Just more generally, do you think we're almost there yet with the tightening cycles for the central banks? 'Cause I know last time you were kind of encouraging them to keep going with that. And secondly, I just wanted to ask, maybe you could give us a big picture view on all the carnage we've seen in the crypto markets. Obviously you've warned about this in the past. So what is the view about this? How seismic has this event been, and what should we be looking out for going forward?
I think Hyun will be taking the question on the crypto markets. Are we almost there in the tightening cycle? Well, I think everyone knows what the central banks have been saying, and everyone sees how interest rates are moving. They started in very large moves, and now the moves have become smaller. And obviously, they started large because the further away you are from where you would like to be, and you would like to move faster. The question now in the markets, as you know, it's more about roughly when the terminal rate is going to be, and once you are there, for how long interest rates will stay there. The simple answer is one is closer than one was at the beginning, but we don't know exactly how far central banks will have to go. And it is, as central banks have emphasized, they need to be very, very data dependent. If you go back to what I said earlier, the conditions that we're facing are unprecedented. Probably, if you like, the enemy is an old enemy and is known, but it's a long time since we have been fighting this battle. And so we will have to see. What is important for central banks is to remain also flexible enough to adjust to evolving circumstances until the job is done.
Yes, Mark, let me just add a couple of additional comments. I mean, on your question, are we there? We have to distinguish between three things: how rapidly you reach what you regard as being adequate. So so it's, if you like, the combination of how fast, how far, and for how long. So there are three elements here. And on all three elements, we are getting guidance from central banks, and for those central banks that actually publish their views on where rates will be, and we will soon have another reading on this when the Federal Reserve comes out with a dot plot. We will get a sense of where central banks believe we are in this particular cycle. On crypto, yes, it's been quite. I mean, you put it as seismic. There has been quite a big shock to the crypto markets. I think what the recent episode has shown us is that although crypto operates under the banner of decentralization, it is actually quite centralized in many respects. So, I mean, first of all, even though they operate on public blockchains, many of the coins that are sold are actually decentralized in name only. So, if you like, it's Dino, decentralized in name only. They're actually quite centralized. When Terra Luna, when the Terra blockchain blew up in May, there wasn't really much doubt as to where you need to look to actually see who was actually responsible. So it wasn't simply a kind of dispersed responsibility. But the other respect in which crypto is quite centralized is that most of the activities took place through very traditional intermediaries. So this is not really crypto on the blockchain. This is people taking in deposits, essentially in unregulated banks. And I think what we've seen is that the kinds of deleveraging and maturity mismatch that we're very familiar with from the GFC was very rampant in the crypto world. And so I think as we look ahead, we should put this into context, and this is very much about the unraveling of some of the very standard leverage and maturity mismatch that we are familiar from the conventional financial markets.
Thanks. So I see we have two more questions in the queue on the overview, so we'll take those two and then we'll go to the special features. So if you do have a question on the special features, you can please start raising your hand or putting your question into the chat as a message to all panelists. And we will go to Paul Davies from Bloomberg, please.
Hello?
Yes, we hear you, Paul. Please go ahead.
Yeah. So my question was on the special features. Should I ask it now or should I wait?
If you could just wait for a minute, please. I think
Sure.
Greg Ritchie also had a question from Bloomberg. Greg, is your question about the overview? Greg Ritchie.
It's also on the special features.
Okay. Let's go to the special features now then, and Greg, since your line is open, please go ahead.
Yes, thank you. So on the interesting feature on hidden dollar debt from FX derivatives, I note it concludes there is a need for statistics that track the geography of outstanding short-term dollar payment obligations. Is this something which the Bank for International Settlements is planning to facilitate in the future, perhaps by changing the way you collect derivative statistics so they include some sort of insight into counterparty country breakdown?
Okay, actually there are a number of points that are worth mentioning there. Since the special feature we wrote with Pat and Bob in September 2017, things have moved on, and there is more information, some more information available. In fact, the BIS is supporting those information gathering exercises. Supervisors now have information about the FX swaps of GSIBs, and that is the globally systemically important banks, and that's a very important step forward. That information is not public, but it is available to those that matter most, which are the supervisors. So again, that's a big step forward, but it's only about banks. My colleague, Pat Maguire, has just written a piece where he suggests possible ways forward. Indeed, it would be possible to change the international banking and financial statistics in order to provide more information. So that's something that can be considered. But more generally, there is also some effort internationally when it comes to the balance of payment statistics. And that's another area in which we might see more information about FX swaps going forward. But this is definitely a very important part of the overall data or statistical information set that we would need to close. And the whole point of the special feature is to draw attention to this matter.
Okay, now we'll go back to Paul Davies from Bloomberg. Paul, please go ahead now. Thanks. Thanks for your patience.
Hi. Yeah, thanks for taking my question. So it's about the same feature. And my question is, do you have a sense of who are the counterparties to this hidden debt? Is it mainly the banking sector? Is it mainly the banking sector local to the non-banks who have this dollar debt? And a sort of a broader question related to that and related to your other work on MBFIs. How are banks and regulators doing enough to understand the counterparty risks between the banking sector and the non-banking sector? And are the stress tests that are being done these days giving us a good picture of those risks, do you think? Or do you think we need to kind of think more about worse scenarios when collateral fails or people default on swaps and LDIs and all that other sort of stuff?
On the first question, actually, the special feature, as you will see, does break down the exposures as between banks and non-banks, and there are a number of statistics there. On the second point, this is going back to what I was discussing before about the exposures of banks to non-bank financial intermediaries. Is that right? More generally.
Yeah, exactly. Yeah. And whether we understand the counterparty risks well enough, whether our current stress testing is giving us a good picture of those risks.
I mean, the stress tests always give you a picture, and they're always useful to that extent. But typically, it's easier to measure your direct exposures to a counterparty than to understand the more indirect exposures that tend to emerge when the system as a whole comes under stress. And so very often you're hit from quarters that you didn't expect at all. So there has been progress, but the progress is always going to be limited. I think we need to be realistic about what these tools can do, and at least I've noticed that over my long career. And the exposures in general, particularly if you look at them from a systemic perspective, are indeed rather opaque and difficult to tease out.
And the next question is from Li Wei Wang. Please go ahead.
Yeah, so for the very interesting feature on currency internationalization, I see RMB is the one growing the fastest. Just wondering, what's the underlying driver for, first of all, these emerging market currencies, and then specifically on RMB? Is that mainly because the US is in fast tightening cycle, or say the potential of sanctioning, or it's because strengthening trade between EME or say developing countries. I'm just wondering what's the reason behind this increased EME currency internationalization?
Yeah, thank you, Li Wei, for that question. We don't think it's related to monetary tightening as such. I think it's more, and it's not really the real side, through the trade, the financing side. It's more that I think a very reasonable conjecture as to why EME currencies have become more internationalized and having more counterparties that are residing in jurisdictions outside the currency issuing jurisdiction is more that the nature of the financial flows have changed over time, and in particular after the GFC, there's been more of a shift towards capital markets rather than through international banking, and capital market trade in particular, for example, sovereign bonds, corporate bonds. And whenever you have bond markets, there are more transactions that are involved. There are many more chains in the intermediation, process. So that I think is a reasonable hypothesis. So it's more about the changing structure of financial transactions rather than either the current monetary policy cycle or the or international trade as such.
Okay, there are no more questions in the queue at the moment, so just a last call then. No, Mark Jones from Reuters has a question. Mark, please go ahead.
Yeah, just a follow up on the point you were making about the internationalization of EM currencies, and you were saying that you get a lot of failed trades effectively in that market, and it could undermine financial stability. Can you just explain that? How does that happen? If you were explaining it to your, elderly relative or something like that, why do you get financial vulnerabilities as a result of that?
Yes, Mark, I think you're referring to the settlement risk special feature. Am I right?
Yes.
Yes. Well, here we're talking about counterparty risk. In particular, the risk that you've agreed on a transaction, you fulfilled your part of that transaction, so you've paid your money out, but somehow for some reason, due to a technical glitch or due to some problems with the intermediaries along the way, you don't actually see the money coming your way. So in particular, there's a very famous historical example of Bank Herstatt in the 1970s, 1974, which actually, if you remember, was the motivation for setting up the Basel Committee on banking supervision. So it's more the settlement risk where two transactions belong together as a set of connected transactions, but for technical reasons, perhaps due to some glitch in the infrastructure, or there's some default along the way, you don't actually see your side of that transaction. And typically the way that we deal with this, as I explained in my introductory remarks, is this institution called PVP, payment versus payment. And there are institutions, there are centralized institutions, and we mention a few in the special feature that actually play a centralized intermediary role, so holds the funds for safekeeping and executes both at the same time. And that's a typical way we can deal with counterparty risk, settlement risk in particular. But those institutions are still yet to be fully developed for many emerging market currencies, and we're highlighting in this particular special feature that that's one area that still needs to be addressed.
Li Wei, do you have a follow-up question? Li Wei from Kai-Chen.
Yeah.
Please go ahead.
Yeah. Just follow up on RMB, which the survey showed it increased the most. The mechanism you described just now, I think it's relatively steady after financial crisis, but RMB did jump in this survey. So what conjecture do you have for RMB's kind of this round of increase?
Yeah, so Li Wei, I mean, we have a number of a number of possible reasons that we explore. I don't think we have definitive evidence, but what we can certainly do is to match you up with the authors, and we can give you a more detailed briefing on the kind of mechanisms that may be at play.
Hey, thanks. We'll come back to you, Li Wei. Greg Ritchie from Bloomberg. Another question, Greg?
Thanks for taking my question. It's still on the same hidden dollar debt feature as before. It describes a few times how policy responses to previous dollar funding squeezes are set in a fog because of the lack of information on the geographic distribution of the risk. Could you describe how, say, the March 2020 policy response of central bank swap lines might have differed had policymakers had this geographic information?
That's a very good question. It's always better to the more information you have, the more targeted your response can be, and the more timely the response can also be. So that's a general statement. Going beyond that would require one actually facing a particular set of circumstances, and therefore realizing exactly what the response should be. But it is clearly important to have a sense, if you like, of the overall geography of the problem that you're facing, as well as of the more specific trees, if you like, within the forest. What is quite encouraging, as we said earlier, is that the particular positions of the banks nowadays are known, but those of the counterparties of the banks are not known. And this ties back to what I was saying before, the fact that the non-bank financial intermediation sector has grown so much. And indeed, we had a previous special feature in the quarterly review that was discussing the use of the extensive use of these instruments on the part of Asian institutional investors. So the more the overall configuration of the landscape and the balance of demands as between banks and non-banks has changed, and that is something that would be very useful to have more information about.
Okay, so just a reminder to everyone that the embargo on the quarterly and the contents of this media briefing lift at 1 p.m. Basel time on Monday. So I don't see any more hands raised or any questions in the queue. So I think with that, we'll wrap up. And thanks very much to everyone for joining us. And we look forward to reading your articles on Monday.